Hello, welcome to BST Live, the show for systematic and algorithmic traders. Glad you could join us today, where we're going to be talking about systematic crypto, tongue twister. And joining us today is Adrian Reid from Enlightened Stock Trading. Welcome, Adrian. Great to have you here today.
Hey, Andrew. Thanks so much for having me. Super excited to be back on the show.
Yeah, well, you were here. I've got this in my notes. You've been on the show before. Episode 147, which was in May 2018. So what's that, like 2.5 years ago?
Yeah, absolutely.
Wow, so that's gone pretty quick because it doesn't seem like it that many years ago. But it's great to have you back again. If people want to see that show actually or listen to it, because it was audio only back then, that was episode 147. We were talking about building trading strategies with confidence. So that was a good episode if people want to go back and review that one.
Yeah, absolutely. Definitely worth listening if you're keen on improving your confidence in your trading systems.
Exactly. So today we're going to be talking about crypto, systematic crypto. My mouth is just warming up, so I'll be able to say that a bit clearer next time. Before we get started, how about a little bit of background on yourself, just to give us a bit of context? So maybe share a little bit about your trading and what you're trading now, that type of thing.
Sure, absolutely. So I've been trading systematically now for, it's pushing 20 years. So not quite 20, probably about 17, I'd say. I've been in the markets for 20 odd years, but it took me about 2 to 3 years to really figure it out and realize that my emotions were just killing my trading results. And so I discovered systematic trading. And the day I implemented my first trading system, you can see on the equity curve, things turn around. And so basically, as soon as that happened, I realized I'd found my thing. And I've been trading systematically ever since. I do my best to trade 100% systematically. I have had a few, dabbles, usually resulting in losses. And I learned that lesson a few times over and over again, but I'm getting better. And so basically for the last 17 odd years, I've been trading stocks systematically, developing trading systems to eliminate my emotions, get better diversification, and reduce the time, effort, and stress in my trading. Crypto came along, and I guess like a lot of people, I sort of looked at it skeptically, dodgy sort of market, decentralized, no rules, no regulations. And I was a bit, no, that's not me. I trade stocks. But to be honest, that conservatism, maybe in the very early days was warranted, but now not so much. And I'm really excited to bring the systematic approach, developing portfolio systems to trade portfolio of instruments into the crypto space, because it's just amazing. Such a great opportunity for traders.
Okay, well, that was an excellent summary of all the points I've got in my list here to talk to you today. So thank you very much for that. So how about we get started with why now? So crypto markets are obviously very hot, and they have been a hot topic for a couple of years now, but I guess relatively new compared to other markets. So why do you think now is a good time to be getting into crypto?
Look, there's a whole range of reasons. I mean, the first one is the obvious one. There's a huge profit opportunity for informed traders. And the way you know there's a huge profit opportunity is if you just look at what the market participants are doing. There is masses and masses of uninformed, completely new traders who have never traded anything before, who are swamping into the or flooding into the crypto markets. And they're using social kind of tips. There's thousands of people on Facebook trying to ask, well, what crypto should I buy and what's going to the moon? And basically it's immature in terms of the masses. And that's why there's an opportunity. Because if you go way back in stocks, in the early days, before there were hedge funds, before there was high frequency, before there was all of this algo trading, it was just dead easy to make money with relatively simple systems. And to be honest, you can still make great money with relatively simple systems. They've got to be a bit more elegant nowadays. But in crypto, because there are so many traders who just don't really, have a structured approach, a systematic approach which eliminates the emotion inherent in all of that and eliminates the emotion inherent in the volatility of this market, will absolutely crush it.
Yeah. So I think, there's obviously some edges, opportunity around the way these market participants are acting. Before we get into that, though, can you share a little bit about some of the things that you see traders doing wrong or with their approach to the crypto markets?
Yeah, absolutely. I mean, the first and most obvious one is a broad-based adherence to buy and hold. There's this idea that's very popular in crypto that if you just buy and hold, you'll be a billionaire or a bazillionaire, whatever it is. And if you happen to choose the right tokens, that might be true. And if you just held Bitcoin, maybe Ethereum, that might be true. But the reality is, this is so new, we don't really know where it's going in terms of the market direction. We know that it's a very strong market. There's a lot of hype right now. But if you do buy and hold, you've got to sit through absolutely gut-wrenching drawdowns. And I don't know about you, but I'm not a fan of 70, 80, 90% drawdowns. It just doesn't fit my risk tolerance and profile. And so I think buy and hold is probably the biggest mistake or risk, because most people will get into that massive drawdown, panic, think they've made a mistake and dump it because they just can't cope. So I think that's probably the first big one.
And they usually dump it at the bottom as well, don't they?
Well, that's exactly right.
Wrong
That's what
time.
creates the bottom, right? It's the capitulation.
Yeah.
The other big thing I think is because it's a new and interesting market, it's brought in a whole new generation of traders who are yet to learn a lot of the lessons that many of the listeners have probably learned over the last 5, 10, 15, 20 years of trading, right? And so there's a lot of people listening to random people on social media for tips. You go into the crypto Facebook groups, it's all about, well, what should I buy today? What's going to the moon tonight? How can I get rich next week? And there's just no structure in the way a lot of people are trading. And in reality, we know if you want to succeed as a trader long term, you've got to have a disciplined approach, and you've got to have a set of rules that will guide you, that'll keep you out of trouble and actually be profitable. So, listening to those social kind of tips and pressure and fads, all of that. And a big part of the crypto market, which makes that dangerous, is that, there's a lot of pump and dumps in this space. I mean, think penny stocks way back, where one broker might just get hold of a penny stock and really pump it, push the price up, and then they cash out and it crashes. It's exactly what's happening in a lot of the smaller tokens as well in the crypto space. So again, if you don't have a strategy, a set of rules to get in early and profit from the pump, you're going to end up holding through the dump, and that's really going to hurt.
Yeah. So so there's some really good points there that you've raised about the things traders are doing that they shouldn't do. The wrong approach to the market is obviously hurting them. And you mentioned about systematic trading and having a set of rules. Before we dig into that more, can you just explain a little bit about the ecosystem for systematic traders? Because there's new tool sets coming out and data availability and all these type of factors that as systematic traders we need to factor into how we approach it. So can you just give us a bit of an idea of what the space is like now for systematic traders?
Yeah, absolutely. And the first thing to realize is it's changing very rapidly. Okay, so there's always, there's new tools being developed and released on the market, almost, weekly or monthly, and so you've got to sort of keep on top of what there is. But fundamentally, there's the decentralized exchanges and the centralized exchanges. The centralized exchanges are where probably the bulk of the tradable kind of volume and tokens are. And so I'm trading, for instance, on Binance and FTX, which are two of the biggest. Binance has the highest volume. FTX has the best interface, combined with really good depth, sort of liquidity of the market. So the first step is choose the right platform. You've got to be really, really careful in this space of the spreads and the cost, because a lot of the exchanges are really just like bucket shops. They charge really wide spreads. They wrap their spread around where they can, around the spread that they're getting in some other market they're offsetting you against, or they're just trading against you. So it's not just a case of opening up an account with any crypto broker and you get the price of Bitcoin or the price of whatever token you're looking to trade. I've compared quite a few notable exchanges. I don't want to name names, but I've compared quite a few of them and looked at the price and the buy and the bid and the ask and the depth across several exchanges at the same instant. And to be honest, some of them are quite scary. So you really do need to go where the volume is. And that's why I trade on those two exchanges. So just be mindful that you don't get reamed by the broker.
Yeah. So that's a good point that you've made about the choice of exchange. But what other aspects should traders or systematic traders consider? Things like data and stuff like that. What else is there
absolutely.
that they need to look at?
So if you're going to be a systematic trader, which I think is great for this market because it eliminates all of that emotion, it allows you to sort of cut through and actually have a profitable edge. So I think we're down with that concept, right?
Yep.
So you need a data source, you need software to design and test your systems, and you need to be able to execute the systems. Let's talk about data first. I trade on daily and weekly bars. I don't trade very short term. And the reason for that largely is lifestyle. I don't want to spend a whole lot of time doing this. I spent about 3 minutes. Actually, it took 2.5 minutes this morning to do my crypto trading. I ran 6 systems on daily bars this morning, and that's all it took, and I'm done for the day. So you need data. And if you look at each exchange, the problem with the data is that they'll only publish the data that they have for the tokens that they've had while they've had them. So it's hard to get a long time series to design your systems with.
Yep.
And this is the first problem. When I first started looking at crypto, what I found was that you couldn't really design a system adequately because you couldn't get a long enough history to get enough bull and bear cycles in your backtest in order to design a system with credibility. So my first step was to piece together data from a range of different sources to get a longer time series so I could really look at how the systems were performing. But now, thankfully, you can get daily bars for a very broad range of instruments all the way back until inception from an independent data provider. So if you look up Brave New Coin, great source of data. They pull data from a large number of exchanges globally. They clean it and aggregate it and publish as a complete database. And you can get the Brave New Coin data from NASDAQ data, and it's on daily bars, so it's not for intraday trading, but really good data set, which we didn't have just a little while ago. So that's the first step, good data. Second step is software. And what I've noticed in the crypto space, much like Forex, is that there's a proliferation of, trading robots and bots, and algos and platforms that will allow you to auto trade and so on, which sounds great in theory. But the big challenge with almost all of them is that they're pretty simplistic. They allow you to trade one ticker at a time with one system. And what they miss is the ability to trade a portfolio of instruments with the one system. So in stocks, I don't trade Amazon. I trade the entire US market and I apply my systematic rules to it. And what's missing in a lot of the crypto ecosystem now, at least the popularized space, is the ability to trade a portfolio system. And so what I've done is develop systems using this data set. And I developed them using Amy Broker, which, there's multiple different trading software you can use, but it's a portfolio-based backtesting engine. And so my systems allow me to trade the portfolio of tokens with a particular system. And then I have a portfolio of those systems to trade. So a portfolio of systems, each trading a portfolio of tokens, gives you much better diversification. So what's the thing that's missing and what a lot of crypto traders are doing wrong is trying to create a bot or an algo or whatever for just one ticker. And, there's not really enough data for that. Like, yes, it's possible, but I'd propose that most will have far more success in the long run by having a portfolio-based approach to their crypto trading.
Yeah. Okay, I want to dig into that a little bit more in a minute, but we've got a question about data in the chat, which I think is a very common one here. So it's from Jeff. Thanks for the question, Jeff. How do you backtest crypto since there is not much history? Are your systems developed off short-term backtests? And if so, do you consider them valid?
Good question, Jeff. I've actually got, Andrew, there's a slide in the pack that we developed. It's the number 6. If you want to just pull, can you pull that up?
Sure. Here we go, number
So,
6.
what's interesting about crypto is that the time frames compared to stocks are really compressed. So the bull bear cycles are much faster. And so while we don't have a lot of data in crypto, we are starting to get a number of bull and bear cycles in the data set that we can test with. And that's what's really important, because what we need to know is, with our strategy, is it going to blow up and destroy our account, when the bull run is over? Because that just, that makes the whole exercise pointless, right? We've got to keep our money. We've got to keep growing our capital. So this chart just basically draws a few comparisons. I mean, we've got a few years of crypto history now, depending on what data source you get. If you use the brand new coin data, you can get back to 2017 and start to get a decent breadth of indicators, of tickers from back then. But during that time, we've been through about 4 cycles, depending on how you measure them. And now in stocks, if you go back 30 odd years, maybe we've got about 8 cycles, again, depending on how you measure them exactly. So yes, we don't have as much data, but we're starting to get there. And so now what you can do, Andrew, you can take that slide down if you like.
Sure.
Now that we're starting to get those bull bear cycles come through, we can develop systems and have confidence in them. But the key is, I believe there's still not enough data to optimize the same way you would in stocks. Because in stocks, you've got thousands and thousands of stocks. You've got exchanges all over the world you can do out-of-sample testing on. You've got 30 odd years of history. So my approach for crypto systems is a little bit different. What I'm far more interested in is optimizing to ensure the system is stable, broadly stable, pretty much regardless of what parameters we choose. I'm not looking for the best parameters. I'm looking to make sure the system is not going to blow up. So if we take that approach of looking for real stability across the parameter space and only accept and trade systems that are inherently very stable no matter what parameters you choose, then you take those systems and diversify the parameter sets. So you've got a bunch of different varieties of those systems. Then all of a sudden you're starting to get a lot more confidence in the way you trade. So long answer, short answer to the question is, look, yes, I think you can develop systems. My systems are on daily bars. The holding period is anywhere from 1 to 2 days to 4 to 6 weeks, depending on the system. And in those back tests, there's now many hundreds of trades in the back test. And if we're careful on how we optimize and develop those systems and really look for stability, you can actually rely on them.
Right, okay. Because that was my next question. What about sample size, especially if you're trading daily bars? Then you have a lot less, data and opportunity for trade. So you look at them across the entire portfolio of instruments that you're looking to trade. That's how you assess it.
Yes, absolutely. So because I'm using daily bars, you do have to look more broadly. So you've got to look at the biggest universe you can to get enough trades into the database. And you also need the biggest history you can, because you need to make sure you've got as many of those bull bear cycles in your backtest as possible. So, if you have one exchange, like let's say you're trading on Binance, you can take the Binance data and develop a system and check it works. But this is not enough. You need to look at data from other exchanges as well, because Binance will change its universe. And there's also probably built in some survivorship bias in the universe that ends up on some of these exchanges, because they're filtering for the large market cap stocks. So that's why you want to go more broadly. And I think if you get 400, 500, 600 trades in a back test, if you design the system to be elegant and simple enough, that can be enough to have a system that's stable and works real time.
Yeah. And what about the little, nuances with data? Say, for example, you're using daily bars. What time does the day end? Could be different across exchanges, and you test a strategy on one set of data and then you try it on another, because it's decentralized. You get different prices. So what have you found about little things like that? Does that make a big impact in the results?
Yeah, interestingly, it's a consideration, but it's not a showstopper.
Right.
So what we've done is, and we've got a program called the Crypto Success System, which I kind of explain all the nuances. But one of the things that we talked about there was that the daily cutover is a universally accepted time where the daily bar sort of ticks over. So that's kind of the same. But even if you use a different time frame to cut over, and you can adjust your data depending on what data source you're using to shift your day, your definition of a daily bar. and then backtest again. So you can actually get slight variations on the data just by saying, okay, this is a day. Oh, no, now this is a day. Oh, no, now this is a day. And just sort of time shift it a little bit. And that also gives you some extra data to test on. And what we found is, again, you design the systems right, simple, elegant, and take into account the nuance of the way the crypto markets move, and it really doesn't matter that much.
Right. Okay.
Yeah. The key is to understand how your system will work given the volatility of the market, given the size of the tails in the or the wicks in the candles, and the way that sometimes there's nice long trends and sometimes there's pump and dumps. You need to be able to deal with both of those.
Yeah. Right. Yeah. So I guess maybe the next question out of that is, what type of systems are you talking about here? You've said they need to be simple and elegant, and they need to take into account the the behavior or personality of the crypto market. So what type of things are you talking about here?
Might be worth. Do you want to flick to some of the slides on the
Yeah,
behavior
sure.
of the crypto market, and then I can talk to what does that mean for the type of systems? Would that work?
Sounds good. Yeah, let me
So
put
let's go
this
to
up
slide
on the
1.
screen. Here we go. Yep.
So the first thing here is, this is a chart of Bitcoin over the last several years. First thing to notice is that the bull markets are very fast and sharp. They don't last that long, but they are exponential. And the market really skyrockets. But after the bull market is finished, there's typically a very sharp correction and a long period of nothing, which is very painful if you've got the wrong style of system. And then all of a sudden there's a new bull market and it rockets up, and then the same thing again, more pain. So you're seeing this cycle play out 3 times on this chart alone. And so I think the first thing is, my preference is not to be always in the market. If I had let's say the stomach to sit through the 90% drawdowns, then fine, always in the market might work. But that's just not me. I'm just not interested. So I want a system that will get me in when the market is moving, but then be very quick to stand aside. So think very carefully about the market regimes that you trade in and when you stand aside. And one of the mistakes that many, many traders make in this space right now, again, because there's so many new traders coming into the market, is they're keen to trade all the time. Whereas my approach is, patience is what makes you the money. You got to wait for the right conditions. You got to wait for the signal. And so in my system development, what I'm doing is filtering out a lot of the market phases that I'm just not interested in sitting through. So that's the first observation. Let's go to the second slide.
Second slide. There we go.
Okay. So the next consideration here is that the declines are really sharp and sudden. So from an all-time high, you can go straight into a 50% decline, that happens over the space of just a couple of weeks or less. So the key here is you want your systems to be fairly nimble. Okay, so we're not going to use ultra wide trailing stops and trend follow like you might in stocks and get really great returns in stocks, because it just won't work here. You've got to get out more quickly. So yes, trend following works, momentum works, but you need to have some cleverness in the way you exit, because the market does turn around pretty sharply. And you've got to be careful of the whipsaws when the market's in a consolidation range. So, a lot of people will call the bottom. A lot of people will say, oh, it's over, we're making money again. But really, it's just a big rally in a sideways market. So it's easy to get tripped up by that. Let's go to the next one. This is some observations or just some illustrations of the pump and dump style move. And, I think everyone knows what the term pump and dump means. But in this space, it's phenomenal how often it happens. And so out of nowhere, people can start pushing a token and it rallies. You see here on the left an example of a 500% rally, and on the right, it's almost similarly big one. And it just skyrockets and then disappears to nothing. Now, if you get on these early enough and you have a profit take in the market, then you can actually make a huge amount of money very, very quickly with this style of move. So you don't need to be fearful of the pump and dump. You just need to be nimble. And so, I'll buy on a lot of the systems are entering on breakouts, and I know you love breakouts. But if you have a profit target in the market to get you out, and be willing to get out before it really looks like the high is in, then you can make a lot of money from moves like this. So you can either sit through the drawdown and go, okay, well, that was a pump, it wasn't a trend, or you can actually set the exit so that you can profit from these and increase your capital as they come along. You're not going to know the difference in many cases in real time. So you want to combine the concept of momentum breakouts with, exiting on strength at times, and also a nimble exit if strength collapses.
Yeah.
And then let's go to the next one. So one of the interesting things is because of the amount of social chatter and trade and social kind of interactions going on in this market, there are very short-term hype sort of events and short-term fear events as well. And so what you can see on the charts is really big upper and also lower wicks on the candles. And so I don't use, for instance, in-market stop losses on this, because the lower wicks are very big and very frequently they just get hit and it bounces straight back up. So I'll use a slower exit to cut my losses. I still cut my losses, but I'll wait for the market close, the tick over of the daily bar, and exit then rather than exiting on a stop loss in the market, because it's just too often do your stops just get hit. But the opposite is actually true of your profit targets, because you've got these massive upper wicks. Assuming you're trading long, if you've got a profit target in the market, then every so often you can blink and you've got a 250% profit on a trade. You say, oh, I just got, profit target got hit. Okay, but now it's way back down there. Okay, but it happens, and it happens over and over again. Mm-hmm. So a system that takes advantage of that sort of move is quite powerful as well. Probably the last one. Let's just look at the last slide here. There's a huge amount of hype, like I've said a few times, and new initial coin offerings coming all of the time. There was a big boom in this back in 2017, which I missed. I wasn't in the crypto market back then. But here's the danger of the hype and also of buy and hold. If you found the new, the next big thing and you bought it, expecting it to go to the moon, you might get, some initial excitement, but most of the projects have really no future. And so the token will just disappear, fritter away to nothing. And so if you bought that at the left-hand side of the chart expecting to make millions, then on the right-hand side of the chart several years later, you're left holding this dud and wondering what happened. So again, buy and hold is not so great. You want to get out when it's clear there's no more momentum in that market.
Yeah. So most of your let me just switch the slide off. So most of your strategies are really momentum based. Is that what you're saying?
Look, momentum works really, really well. So yes, I have momentum strategies, but I've also got rotation strategies, rotational momentum that works. Not always in the market, mind you. So rotational with a regime filter. And I've also got mean reversion systems that work. So basically what I've found is that because it's such a new market, because it's still so emotionally driven, a lot of the concepts that have always worked in stocks and maybe might be eroding a little bit now because there's so much kind of smart money and high frequency and so on. A lot of those strategies can be adapted for crypto really, really well. And that's basically what I've done. In the program I put together with a partner. I worked with a partner, Adam Felsman, on the crypto success system, and we built some systems specifically to take into account all of those nuances of the crypto market. And what that allowed us to do is have a really big, broad, diversified portfolio. And we're on the verge of fully automating the portfolio-based approach as well, which is pretty exciting.
Yeah. Yeah. So it sounds like from your examples there that it's very important to consider the type of market environment or the regime. And there's a question here actually in the chat. I might just put this one up here from Simba. Here we go. Simba would like to know, hey, Adrian, have you had much luck with developing a regime indicator? Do you just tend to use Bitcoin as a bellwether for the market?
Yeah, look, I do use Bitcoin as the regime filter. There are other ways you could do it. There's other indices, but to be honest, Bitcoin dominates so much of the market cap of the entire market right now. Not all of it, but a lot of it. That really has been a great source of as a regime filter so far. Now, for exactly what indicators to use as the regime filter, that's something you're going to have to test. What I'm going to suggest is we don't have a lot of data. I think we said 4 bull and bear cycles sort of that we've got meaningfully in our data right now, something like that, depending on how you define bull and bear. And so you've got to be really careful with your regime filter not to curve fit the regime filter, which is a big trap, right? Because let's say you have a regime filter that turns your system on and off 4 times and it works amazing. And you optimize that regime filter and you get this really great looking equity curve. And you think, oh, I'm cool because I've got 500 trades in my database, but I've got and this regime filter really makes it amazing. Actually, no, you're in real trouble here because you've optimized something on basically 4 data points, 4 on-offs, which is a real big mistake. So for the regime filter, the important thing is to make sure that the regime filter works very broadly, no matter what the settings. And this is what I was talking about earlier, the stability of the system. We've got to make sure that we're not curve fitting. And, maybe you have one system with a regime filter of X and you have another system with a regime filter setting of Y intentionally, not because X or Y is better, but because you want to build in that diversification because we don't really have enough bull bear cycles yet to properly tune a regime filter.
Yep. Yeah, that's an excellent point. We've got a question here from AW, which is kind of 2 questions in one. First of all, is your crypto approach even applicable to the futures market, considering it's a one or none contract? And I guess maybe the second part is about holding overnight or over the weekend. So what do you say about that? Does it apply to the futures markets?
Look, yes. I mean, first of all, I don't trade futures. I trade stocks and crypto. So I'm not sure that my comments are going to be that relevant. But I would say anywhere where you're trading a single instrument and struggling for diversification, the portfolio approach can really help. The challenge in the futures markets is a lot of the contracts are really big. And so unless you've got a decent sized portfolio, it's kind of hard to trade a portfolio system. I mean, to meaningfully trend follow in futures with a broadly diversified portfolio, that's kind of tough. I mean, getting easier with the micro contracts and so on. So I would say it's more applicable to crypto. And the reason is the minimum trade size is basically there is no minimum. And so even if you've got a small portfolio, a couple of hundred, couple of $1,000, you can still get a really good diversified portfolio using a portfolio system in crypto that you just can't do in other markets. And so this is why when someone says to me now, I've got $500, I've got $1,000, I've got $2,000, what market should I start in? Well, the answer is crypto, because the opportunity is the best. The systems have the most amazing edges, and the diversification potential for a small account is phenomenal. And so that's why it's so exciting for a new trader if you are systematic.
Yeah. You're kind of touching a little bit on risk there, which is, one of the hot topics for traders when they talk about cryptos, the risk and the volatility. And so what do you just spoke a little bit about having the opportunity to take very small position sizes. But how do you think traders should look at risk and volatility in the crypto space?
Good question. Thank you. There's a couple of parts to it. There's catastrophic risk, and there's system risk, and then there's position risk. So let me cover each of those sort of individually, if that's okay.
Yep.
So catastrophic risk, you can't deny that the regulation in this space is evolving rapidly, if I can get my words right. And so what you can trade in one country from 1 week to the next, 1 month to the next can change. And also the future of particular tokens or parts of the market can change over time. So you want to be really cognizant that you might need to be nimble with your strategy, your portfolio, and get out if the market turns down. There's also, it's an immature market, so there's a lot of market shock potential. We've seen some very sudden declines, and so you want to think pretty carefully about your risk profile and your catastrophic risk tolerance. For me, if I think about my whole portfolio, no matter what happens, any conceivable event that I can dream up, I want to be able to trade the next day and still support my family. That's my threshold of what catastrophic risk I'm willing to tolerate. Now, what that means is when I think about something like crypto, I'm not putting all of my assets in that, however tempting it is. How amazing the returns are on the systems I'm developing, they're just a part of the portfolio. And I think that's important because people see, the dollar signs and just go all in. And particularly a new trader with, very little experience, that's really dangerous. And then you combine that with the 10, 50 times leverage that the exchanges seem to want to give you, and instantly people are just blowing up. So catastrophic risk is huge. You also want to think about the exchange risk. So I wouldn't put all my money on one exchange. I am trading actively, so I can't use cold storage because I'm in and out of the positions fairly quickly, and it's sort of a bit cumbersome. But in order to protect myself a little bit there, what I'm doing is I'm using multiple exchanges. On the exchanges that offer leverage, I'm putting some of my assets on there and using leverage and keeping some of the cash separate out of the market. So that's some catastrophic risk protection. The second part of the risk management is the systematic risk, the risk of your systems failing. And this is important because the market's evolving rapidly, and we're seeing new participants entering. There's ETFs coming, and there's broader and broader acceptance, and so the nature of this market may change over time. Well, it will change. How quickly, when we yet to be seen. But you want to know that you have a broad portfolio of systems, so that if one of them fails, you can close it and keep trading with the others, and monitor those pretty closely. So backtesting weekly and evaluating, okay, are the stats doing what they're supposed to be doing? Is this behaving as I think it should given the market conditions? So I'm not trading one system. This morning I ran 6, and I'm developing new systems all the time. And so my goal is to keep building that portfolio of trading strategies so that, when one fails, because the market dynamics shift a little bit, it doesn't actually matter that much. Yeah. So that's systems. And then the last one is the individual position risk. You just can't afford in this market to get married or fall in love with one position. People talk about, oh, this is going to change the world and this token is going to, revolutionize everything. And maybe it will. But trying to call it now is like going back to when the automobile was first invented and saying that it was going to be Ford and General Motors that survived. I mean, who knew? No one knew, but there was hundreds and hundreds of car companies. And the same again with aircraft. When the aerospace industry kind of took off, same thing. Hundreds of massive proliferation of people trying to crack it and change the world. And then same again with the .com. And most of those aren't here now either. So the same, and probably more so in the crypto space, is we just don't know which ones are going to succeed. And so if you buy one and heavily concentrate your portfolio with a couple of tokens, and they happen to be the ones that change the world, congratulations, you're probably going to be a billionaire. But you've got to think, what if I don't? What if I don't pick the right ones? What if the 5 that I pick are the duds and I end up with nothing? My approach to trading is I want maximum probability of a certain outcome, not maximum profit potential with a small probability. Yeah, I'm much more interested in a degree of certainty about what results I get. So therefore, a portfolio of systems, trading a portfolio of instruments with a very low reliance on any one ticker is what gets you there.
Right. Yeah. And I guess as well that you're talking about which cryptos to trade. I don't know the exact number for today. It's changing all the time, right? Cryptos are coming and going.
Thousands and thousands that you could.
Yeah. So do you have some kind of filter or to say which ones you would even consider? How do you manage that?
A lot of that is built into the design of the strategy, the system that you're trading, right? And so you need to look at the charts and the exchanges and look at the spreads and the volatility of the tokens and create rules to get rid of the garbage. Because a system, let's say, I mean, it's the typical trap. Let's say you backtest a system with no commissions and no liquidity filter. And you can design an amazing system that looks fantastic, and you think you're going to be rich next week. But the reality is the spread and the slippage and the commissions are going to kill you. So instead, design a system with strict criteria for how liquid the tokens are, and just ignore everything else. Yeah, there's going to be a bit of FOMO. Oh, I didn't get into that pissy little, 1/500,000th of a cent token that went to 1/200,000th of a cent and got rich. You're going to miss that. But it's okay, because you've got a high level of certainty that the outcome will be good long term.
Yeah. Speaking of liquidity, I guess one of the unique features of the crypto market is that it's 24/7. So do you find that you need to consider liquidity on the weekends, or out of popular times of the day, that type of thing? Is that a factor?
Look, it definitely will be the bigger and bigger the account gets. I'm not trading tens of millions of dollars in crypto because it's a small part of my portfolio. So I'm finding that with a decent sized portfolio, you can get in and out any day of the week without too much trouble, provided you've got the right liquidity requirements on the tokens you're trading, right? And that's all built into the system. So, for me, it has to trade many millions of dollars a day worth in order to make the cut. And so you can usually get in and out. And because I'm so diversified and the positions are so small, it's pretty straightforward. If you were trying to move a whole portfolio in and out, then it's going to be a problem. There's some interesting price behavior that's a little different on the weekend, which I haven't yet developed systems around, but not something that really you need to worry about as a showstopper getting into the market.
Okay. A little bit more on risk here before we move on. There's a question in the chat from Asindu about handling risk. Do you follow a market neutral approach or stop loss?
Look, I'm definitely not market neutral. I'm long only. So, if the market falls, my portfolio is going down. But I do have stops in all of my systems. But I also have price behavior based exits as well, or indicator exits as well. So depending on what the market behavior looks like, I'll definitely get out to protect myself. But in every single system that I've developed in this space, there's a stop loss that will basically get you out in the case of a disaster if all else fails. And I think that's the key. You don't want to be left holding the bag. You don't want to turn things into a long-term hold in this space. Like there's no, like in stocks, again, you see it over and over again. People go, oh, I missed my exit or I didn't execute my stop. Oh, don't worry. I'll just, put this into my long-term portfolio and in 10 years time, it'll be okay. Maybe it'll come back and I'll get out of break even. In this space, so many of the tickers are going to go to zero that you just can't afford to do that. So you need a fail-safe exit to get you out.
Okay, thanks, Adrian. Another question in the chat here from AW. What are you using to trade such a wide basket of exotic cryptos or exotic pairs?
Look, I don't want to give the impression I'm trading, this massive universe. I'm trading on Binance and FTX, right? So they've both got a pretty broad range in the vicinity of several hundreds, but not thousands, right? The trouble with, the more decentralized markets where you're going to get all the really exotic things is that the depth is low. The commissions or the spreads are going to be high, and it's going to be pretty hard to make good money repeatably in that space. I'm not adverse to developing systems in that sort of area, just like I'm not adverse to trading penny stocks. But think about it, the same thing. I'm not going to put all my money in, all my stock money into penny stocks. I'm not going to put all of my crypto money into really exotic kind of off-exchange tokens. But right now, what I'm doing is I'm trading fairly high volume tokens on Binance and FTX, which gives you more than enough diversification, because between them, there's many hundreds of tokens you can trade.
Okay. Thank you. We've got a comment here from Tab John from Poland. It's 2 a.m. when you posted that. So thanks for the commitment. Tab John, well done. If there was a prize, you'd win it. But okay, here's a question about intraday. I know you mentioned that you only trade daily and weekly. Have you actually looked at intraday?
I have not. So, look, strong hypothesis is that, yeah, absolutely, a systematic approach would work intraday. The trouble is the platforms, the ecosystem, I don't think is really up to trading a portfolio approach intraday just yet. I mean, probably with a little bit of work and a stretch, I could use the current platform that we're on, Amy broker-based systems with a live data feed running intraday. Possible. But, when your system's backtest in the triple-digit annual return sort of space with drawdown of 20, 30, 40%, I don't really feel the need to trade more frequently, to be honest. I mean, maybe you could make more money, but it's not really my thing. I've never been an ultra short-term trader.
Okay.
But don't dismiss it. If you're into it, definitely look into a portfolio-based approach to trading systems intraday. I think it could work.
Yep. All right. We've got a question here from Jeff, and then we'll start wrapping up soon. Let me just put this one up on the screen. Turtle systems worked for many years for markets that trended and in markets without much history. What are your thoughts on using turtle systems on crypto?
Yeah, good question. Look, whenever I have a student who asks me a question like, "Oh, what do you think of this rule or this system?" my answer is always the same. It's backtest it and see. And look, I've backtested breakout systems like the turtle, not the turtle system per se, but breakout systems like that. And there's definitely some potential. But because of the nuance of the way crypto moves, you can achieve a lot more by taking into account those nuances and sort of tailoring the entry and exit rules around that. So yes, start there, but also look at all of the systems that you've got in other markets and apply them to the crypto market and see how they do. Because actually, it's probably a good time for one last slide, Andrew, if we've got time.
Sure.
Just this morning, I was mucking around in preparation for this session, and I took one of my existing stock systems. So slide 7 there, if you've got it, Andrew.
Yeah.
I took one of my existing stock systems, unmodified, and I just took out a couple of components of the system that were not relevant to crypto, and I applied it to my data set and back tested it. It's like, oh, I didn't re-optimize it. I didn't change the rules. I didn't change the structure. And to be honest, it's kind of amazing. So, and this takes into account slippage and commissions, and it takes into account liquidity requirements. So it's got a several $1 million a day turnover filter. So actually quite tradable. Is it the best system that we've got? Absolutely not. I've got way better systems than this that I trade myself and that are in the program. But the point is, if you've got systems in other markets, take them and apply it and test it and see what's working and what's not, and then work with that. You don't need to reinvent the wheel here, which is the great thing.
Yeah. Well, we've actually got a good question here from Simon to dig a bit deeper into that comment you just made. What are the most significant things you have had to change in your approach to system building as you adapted from stocks to crypto?
Yeah, good question, Simon. Nicely done. Look, the first one is that the markets turn around very quickly, particularly at tops. So you want to be I'm much more nimble in my crypto systems than I am in my stock systems. In the stock systems, I'm typically a long-term trend follower, and I give them a lot of room to move. But in crypto, you want to be much more nimble and exit much more quickly. Second thing is the timeframes are massively compressed compared to most other markets. So the bull bear cycles happen more quickly. So your system settings will typically be shorter term than they would be in stocks or in other markets. I mean, take, for example, a breakout system in the stock market. You could very easily trade profitably with a 200-day breakout. But in crypto, 200 days is a very long time. So, maybe you're looking at 20 or 40 days or 50 days, maybe at the outside. So shorten them up. And then take into account the price behavior of the wicks and the pump and dump nature of the markets. If you take all of those things into account with your rules, you can do a lot better. So that's why I said earlier, I don't use in-market stops because they just get hit too often. And profit targets in the market can be very, very profitable if you know where to set them. And long-term systems that bank on big trends going forever are probably not as good as nimble systems in this market.
Okay. Thanks, Adrian. We got a question here from Christopher on statistical edges. Is it a bad idea to use historical data before mid-2016 since futures and perpetual swaps changed the nature of the market around that time?
Yeah, look, it's a good question, and I think you're right. That's risky. And what's interesting, the bulk of the data that's available is post that period anyway. And the futures and perpetual swaps are in a small part of the market. It's not like you have those sort of contracts on every token. So I think you want to take it into account. I would be very suspicious of a system that performed astronomically well in, say, 2016, 2017, that has since died or has since been kind of lackluster. Don't trade a system like that expecting to have another cycle like you did back then, because the market has moved on. Pardon me. But there's still huge opportunity. And if, I've backtested systems where it did work very well in those bull markets back then, but it still works well in the last couple of cycles, showing that it's not a showstopper. The market dynamic or structure hasn't changed that much. So it still works.
Yep. Okay, thanks for that one, Adrian. Let's tackle this question from Mike. And before we start finishing up for today, so it's from Mike. Are your systems robust or simple with few parameters?
Yeah, absolutely. They have to be, because we don't have a lot of data. Instead of simple, I'm going to use the word elegant, okay? Because you've got to be careful here between a simple system, which is simplistic, moving average crossovers, simple breakout system, channel breakouts, that sort of thing, simplistic, and elegant, where there's a bit of nuance to take into account the way the market moves. So yes, they're simple, but they're kind of elegant in that they'll adapt to the way that the crypto market moves and profit from that. Few parameters. And the critical thing is, when you're developing the systems, you're not optimizing to get the optimum result. You run your optimization to check that the system performs well pretty much no matter what value you choose. Because we don't have a lot of data, you've got to make sure the system is really, really robust to the parameter settings. So if I have a system that works with a setting of 50, but it doesn't work with 60 or 40, then it's going in the bin. But if it works with a setting of anywhere from 20, 30, 40, 50, 60, 70, 80, then maybe it gets a look at. That's really, really important, just because of the data problem.
Yep. Okay. We've got a question here from Tim. I think we'll finish up on this one. This is a good question. Adrian, can you outline your system development environment and execution workflow? How do you code, and do you manually or auto trade these systems?
Okay, yeah, look, there's a lot in that. Okay, so the environment, so I'm using data from Brave New Coin. I'm using Amy Broker to backtest the portfolio systems. The whole development process we don't have time to go into here, but basically it starts with a hypothesis concept based on observation of the market. So I'm looking at market behavior, saying, okay, I'm seeing this type of behavior over and over again. What type of system would capture that? And then I'm developing that the system based on that hypothesis to see if I can build something profitable out of it. So execution-wise, what I'm doing is, when the daily bar ticks over, I'm updating the data and I'm running the system immediately, and I'm placing the orders. Right now, I'm doing that full auto, but that's only new this week, right? So up until last week, I was trading these manually. So you update the data. It takes a couple of minutes to pull down the entire data set, import that into Amy Broker, run the backtest to generate the buy and sell signals, and then go to the exchange straight away and place those orders. So that whole process takes just a couple of minutes. The rate limiting step is kind of the data download, which now we've got down to just a minute and a bit. So that's quite good. The market doesn't move that much in that time. So we're getting really close to the opening price, which is what the backtest assumes.
Right.
Now, I'm trading now on full auto. There's still a few bugs we're working through, but from start to finish on full auto, it's taking about 2 minutes to run 6 systems and across trend following, sort of momentum, rotation, mean reversion, across a portfolio, the entire sort of universe that Binance trades. So it's really quite quick and pretty exciting. You can do all of that on automatic.
Yep. Okay, thanks for sharing that. So there's a few more questions in the chat, but we're just about out of time. So how can people get in touch with you if they have more questions?
Yeah, great. So there's a couple of things. First one is I've put together a little package for people to benefit from what I've learned in the crypto market. The first one is I've put together a crypto acceleration bundle, which is the 20 killer crypto trading mistakes, a couple of articles, and a course to get your mind right about how to approach trading. So you can get that at go.enlightenedstocktrading.com/crypto. You can also just go to my website, enlightenedstocktrading.com, or email adrian@enlightenedstocktrading.com. Love to hear from any of the listeners.
Yeah. Okay. Well, thank you very much for preparing that for the listeners today. It's much appreciated. So is there anything else that you wanted to mention before we wrap up? Because I know you've shared a lot of stuff. Is there like a way you can summarize that in 30 seconds to a minute?
Yeah, look, the big thing is just because the market is new, you don't have to throw your long, hard-earned discipline out the window. Okay, a systematic approach works and it eliminates the emotion. Now, the challenge is in crypto, the volatility of the market is bigger than pretty much anything else. You know, you can blink and something has moved 40, 50, 60, 100%. And so with that comes emotional fluctuation, which is why you need a systematic approach, which is why I think this is so important, because most people will blow up due to their emotions. Adopt a set of portfolio systems like this, reduce your risk, trade many small positions, and you'll be right.
Yep. Okay. Well said. That's an excellent way to finish up today. So thank you very much, Adrian, for sharing with us all your knowledge and insights on crypto. It was great chatting to you. And thank you, everyone who participated today. Thanks for joining us. We had a lot of great questions in the chat. So thank you very much. And don't forget to hit thumbs up on this video and hit subscribe and the bell icon so that you're notified every time we share some new information. So thanks again for everyone for joining us today. We've got a couple of thanks in the chat as well. So excellent work. Cheers, Adrian.
Thanks so much, Andrew. And everyone, please do like and share the video. And also the Better System Trader podcast. Andrew puts in such a lot of work to bring this to you guys. So please support it and make sure you tell your friends about it.
Excellent. Thank you very much for that little plug too, Adrian. I appreciate it.
Thanks, Andrew. Absolutely.
All right. Take care. Thank you very much.
Okay.
Cheers.
Bye.
Bye.